Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. In today's video, we are looking at 5 different energy companies. Recently, some of you asked me if I can put a video together just looking at some of the energy companies, and that's what I've done today. What you see right now is my portfolio. Right now, as you can see, is all basically 59,193. The market is open right now, so it's kind of going up and down. But yeah, so it looks like it's again we have a green day, just like the last few weeks we had it up and down, so it could change. The week started really well today, but we will see what happens in the next couple of days. Okay, that's my portfolio, and this account is actually in the Trading 212. Now if you are in the UK and you've actually signed up to Trading 212 recently, then you probably are either on the still waiting list, or you've recently got basically a notification to say that they now going to allow you to open that account. So yeah, just look out for that. I think they are doing invitations, so I'm not sure if they're allowing everybody or if it's just invitation only. Whatever it is, if you're interested, put your name out there and just see what happens. And you can click the link in the description section to get a list of free share if you use my link, and I'll get a free share as well. And as always, if it's non-compliant, I basically sell it and give away the money, and if it's a compliant, I keep it sometimes, like this company here. I think I still have it, or have I sold it now? There we go. Under Armour is still here. Okay, so 1 share is right now okay, we're doing okay, I guess. Right, so let's have a look at the 5 companies that we're looking at today: the ticker, the company, the sector, the business description. We're looking at the economic moat, dividend yield, 5-year dividend growth rate. We're looking at the payout ratio, years dividend increases, the safety, profit margin, the free cash flows, the return from the last 10 years. Although that doesn't tell us what might happen in the future, it kind of gives us an idea. And then the next 5 years, the expectation or the estimation. Again, remember, this is based on what the analysts think, so you have to really think about that. Obviously, take it for what it's worth. Morningstar, we're looking at their valuations, and we're looking at their fair value price. Okay, so the first company we're going to look at is Chevron. Chevron is one of the biggest oil companies out there. They are basically the energy company with exploration, production, refining, and operation worldwide. They have a narrow economic moat, 3.55% dividend yield, 5-year growth rate of 4%, payout ratio 38. Years dividend increases 34 years in a row. They have basically 90% safety, profit margin of 14%, free cash flow $30 billion. Now these companies do go through a lot of capital, so you have to bear that in mind. Total return, we're looking at about 6% in the last 10 years. Growth estimated basically in the next 5 years, they're expecting about 14%, which is really good, and they're fairly valued right now at $149 per share. And now some analysts came out today and actually said they're expecting the price to be 194, I think it was, by the end of the year. So we'll see how that goes. The next company we're looking at is a company that I've actually never even heard of, is Arch Resources, and this company deals with coal and consumable fuels. They have non-economic moat, 0.72% dividend yield, 20. So a lot of this information, actually I couldn't find it through its dividend, basically dividend. I had to go to Seeking Alpha to find that information. So according to Seeking Alpha, this is what I've got. Okay, so 5-year growth rate, we're looking at about 23%, payout ratio of 17%, years dividend increases is 0. Safety wise, I couldn't find anything because the company that provides that is actually this company, and as you can see, they don't even have any safety. So that's one of the reasons. And then when it comes to profit margin, we're looking at about 29%, free cash flow of 621 million, and total returns we're looking about in the last 5 years, that is, by the way, 15.55% in the last 5 years, not 10 years. Okay, and then growth estimate next 5 years, what Yahoo Finance doesn't have any, which is shame, because I can't share that with you, to be honest. Okay, it's not there. And then we have the fairly valued at the moment, according to Morningstar, is $145 per share. That's basically the expectation. The next company is Schlumberger, and this company is actually the largest oil field service firm in the world. They have a narrow economic moat, 1.77 dividend yield, 5-year growth rate of -24. That's exactly what I found on Simply Safe Dividend. and payout ratio is about 30%. So they must have cut their dividend. Basically, that's what it means in the last 5 years. Okay, payout ratio looking about 30%. Years dividend increase is 0%. 0 years. Safety, we're looking at about 60%, profit margin of 10%, free cash flow of $2 billion, and the total return in the last 10 years, we're looking about, according to Morningstar, minus 2.88%. And when you look at the growth estimate in the next 5 years, 36%. So that's quite high, and it's really basically cheap at the moment. Well, according to this, it's 19% discounted, and their price is $49 per share. And the next company we're looking at, the fourth company, is Exxon. Again, very similar to Chevron. This company is basically almost does oil and gas company that explores produces and refines oil around the world. And 2021, it produced 2.3 million barrels of liquids and 8.5 billion cubic feet of natural gas per day. That is per day. That is absolutely huge. So they are one of the biggest, is not the biggest company in oil, if you like. I think they are actually bigger than Chevron, because they are, okay, they are definitely bigger than Chevron. So now it doesn't have wide economic moat. It has a narrow economic moat. Dividend yield of 3.65, 5-year growth rate of 3%, payout ratio 29%, and they have increased that dividend over 39 years, which is really good to see that. Even when COVID happened, I think they were expecting to cut it, but apparently they didn't. So 80% safety wise, profit margin 11%, almost $50 billion in the bank. Like I said, they spend a lot of that money, okay, doing all of this stuff. So they capital heavy, these companies. Total return in the last 10 years, we're looking at about 3.55%. Growth estimate in the next 5 years about 24%. So again, these two companies are doing well. All of the oil companies, apart from this, I guess, and this probably is because of oil and consumer fuels, but these three are actually doing well in terms of the expectations. Basically is very high, fairly valued at the moment, and is $102 per share. And the final company we're looking at is the Interplus. This company produces and develops crude oil and natural gas assets in Canada and the United States. So they must be doing really well in the last. It would be interesting to see. In fact, I'm going to check that now, see how they've done in the last couple of months, because crude oil has actually gone up so much. And yeah, I was right. Look at that, 40% up year to date. So that's quite high. And for the 1 year, 145% up for 1 year. So from 13th of September 2021, they were $6 per share. That's crazy. But they went up as high as 18 and came back down at least to 15% in the last, basically since June this year. So yeah, it looks like they're doing really well, because crude oil actually went up so much. They don't have any economic moat, so there's none. 1.31% dividend yield, 12% 5-year growth rate, and payout ratio of 10%. And we're looking at 1 year of increase in that dividends. I think they probably are one of these companies that will increase 1 year and then not increase the next year. So that's why it says 1 year here. Safety 45%, profit margin 28%, which is really good. Free cash flow, we're looking at about 557 million. And total return, we're looking at 1.42 in the last 10 years. That's ridiculous. And the next 5 years, they're expecting 0.82 in terms of growth in earnings, and it's fairly valued at the moment. And $15 per share is basically what it should be. I think that's exactly where it is right now. So even should be cheaper than it is right now. So yeah, there you go. There's 5 different companies. I'll be honest with you, I will not touch any of these companies apart from Exxon and Chevron. These 2 companies have been around for a long time. I know the others have been around for a long time, but these are dinosaur companies. They have a lot of cash, they have a lot of capital, they are very well known, and they have a lot of links with all over the place around the world. So they're not just focusing only on the UK and in the US. So for that reason, if I were to invest in oil companies, it will probably be these 2. The third company I would be interested is an EOG Resources as well. That's the third company I'll probably be interested. But yeah, I'm not going to touch oil right now. I'm not sure where it's heading. Everyone is basically talking about it, saying it's a great place to be right now. It's obviously it's been going up like mad. In fact, let's have a look at the CVX as well and see where it is right now in terms of the last year to date. So 34% up, 36% and 65% up. Exxon probably more or less the same. Okay, 53% and 76% a year to date. So they have gone up so much. Okay, so and again, God knows when the oil's going, it's heading in the next couple of years. So for that reason, I'm not really going to touch it anytime soon. I don't own any energy stocks yet. I'm looking at it, but it's just too expensive. When every time I look at it, I'm like, it's too expensive. From where they were and where they are right now, there's no way on earth I'm going to pay double the price, because I had the opportunity to actually add Exxon and Chevron before, but I never, because I actually wasn't convinced that they're gonna do really well. But they actually done really well in the last basically 12 months. So anyway, that is the companies that I wanted to share with you guys. And finally, I want to show you from Sharia compliance side of things. As you can see, every single one of these companies is compliant. The only one that really worries me the most is this company here. Okay, this has a very high debt, so that could change next quarter. This might go non-Sharia compliant, so you really have to be careful with that one. And also, I think that's it. That's probably the one I would be worried about the most, because 27 is closer to 30%, isn't it? So yeah, that's it. I hope you enjoyed the videos. If you have, please like the video, subscribe to the channel. Let me know if you have any questions. I know some of you asked a lot of questions lately, so I'm gonna get through in the next couple of days, answer your questions, and hopefully I can do a couple of more videos. Work's been absolutely crazy. My voice, alhamdulillah, is back now, so I should be doing a couple of more videos in the next couple of days. Have a wonderful day. Assalamu Alaikum.